Good afternoon. How are you, sir?
Hello, hello. Yeah, it's very hot here.
Oh, it's hot that side.
Yeah, yeah. I think for you maybe not as hot because you're more used to it, but here we are we're very have very hot weather. We have
Oh,
36 degrees.
oh, okay, yeah. It's not that hot though. It's 6 degrees.
For us here it is very hot.
Yeah, for you outside it's very
Yeah,
hot.
yeah,
Here
yeah.
we are used to high temperatures.
Yeah, yeah.
Yeah, because right now I'm even putting on something warm right now. Like it's very cold. Here it's 23 degrees, so it's cold actually.
hmm
Yeah. All right. So we get started. How was your weekend?
Our weekend was very nice. Yeah,
Okay.
did some nice relaxing things and
Mhm.
yeah, that was very good. Some cooking,
Mm, mm. Wow, that's great. That's great.
not that
That's great.
not that much activity because it was so hot.
Ah,
Not that much activity outside because it was too hot.
okay.
Yeah, I like to go outside though, but and also I really like to go hiking and
Okay. Wow,
some
that's
outdoor
great.
things. Yeah, yeah, this is also not bad for trading because you can clear your mind a bit and get some fresh
Yeah,
air.
exactly. 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 But that's good for trading. Yeah. Okay. Yeah, for me, I've been down this whole weekend. I had a fever.
Oh, that's bad.
Common commonly known as malaria in our region because there are a lot of mosquitoes here.
Oh,
So apparently I got exposed myself to mosquito bites and so I had malaria. But I finished my medication
mhm.
this morning today. Yeah, so I'm feeling a little bit better. At least my strength is back.
Yeah. Oh, that's great. That's really great.
Yeah. So anyway, let's get started and let's see what we can do for today. So if I don't go for 2 or for long hours in this session, I it's because I'm not very much fit, but I'm
Yeah,
just
yeah.
trying.
That's okay. That's okay. We can split this or do it to continue another time. It's not a problem.
Okay, all
Your
right.
health is very much important.
Yeah, yeah, exactly. All right. So I believe we last time we finished looking at the market structure.
Yes.
I don't think there's anything that is remaining from your side
Uh,
where you say maybe there's an area where you didn't understand. Is
I mean, we finished about market structure and um, you know when I mark up the charts, should I mark up all the market structure starting from the daily, or is it mostly important to start from something like 4 hours and then go to 50 minutes to see
no
what price has
um
done?
actually like what we did last time, it was just wanted just to show you
Mhm.
how that market structure is consistent. It is one thing that is very consistent in the market.
Yeah, yeah,
And also how that structure sometimes can vary because structure varies. It's not standard, it's not constant.
hmm
You're not going to expect the same type of market structure every time. So the market may decide to do anything which it desires to do, and we just have to respect it because the market is always right. So we did all that kind of markup to just show you to say market structure is not always perfect, it varies. So you just have
yeah.
to accommodate the variation of
hmm
market structure and move on to the next setup that the market gives you, regardless of whether market structure looks to be pleasing or looks to be so exciting or it's something that is not so clear. Yeah, so but when it comes to analyzing the market, much of what I do is I don't necessarily even go to a weekly because I only visit a weekly once, maybe once in a week, because I know where weekly market is. Like you can see for 3 weeks now, the market has just been on the same level. You can see.
Yeah,
So I don't
yeah.
have to visit this area. I already know that, okay, market has been on that level. All right. So even the daily, I don't have to visit it so much because I already know what the daily is doing. Nothing much has changed. So much of the analysis, I would maybe look at the 4 hours, even look, sometimes 4 hours, I don't even look at it also so much because again, 4 hours is very much predictable. So you know what the market is doing again. So what I do is spend much of my time maybe browsing the 1 hour and also checking the M15 because these are the time frames that are quite important when it comes to my trading. Like for today, I was just checking the M15 structure and looking for some nice trading opportunities. Okay, so
Okay.
that's time frame that I look at. Yeah, so like I got into a buy around this area. I was looking for some buys, although I was trying to target that high. But again, because I saw some equal highs right there, but it seems price is beginning to pull back because of this internal structure, which is opposing the market from going up because we had a push, a pullback, we failed to take out that high, then we took out this low. So price seems to be reacting to this supply right here, trying to give us some selling opportunities. Okay, but for me, the bias was bullish.
Yeah.
Yeah, it was a bullish
So in general, when I look at this, what I see here is we have a lot of orders lying here, and now they were all being taken out by this
been
move.
taken out, exactly.
So we might expect some higher prices in the future, maybe.
Yes, that's what I've been also expecting because I was looking at the same area. I was looking at orders that were taken out. So my expectation was now that price should be pushing to the upside. But then I'm still holding on because I've closed some of the positions, right? So I'm just holding on to one small position, which is even if it goes and hits, it closes at break even, it's not such a big deal. But I've closed much of the positions here because I don't again want to hold on because I know we can expect higher prices, but again, the market can still also reverse and go to the downside.
Yeah. Where you got into the trade? Somewhere down here even?
Yeah.
Oh.
That's where I entered from. So I was looking at this, although price never came to hit it. So I used the ICT fib. Okay, so just put it like that. So this is what just gave me the confluence of buying because I was expecting to take a trade right here. So that's what I did. So the moment price just hit there, okay, I jumped. It was much of what I do when I'm trading. I don't set pending orders. Much of my entries are manual entries. Okay. All right. So let's continue to the next thing on the table. So like I said, we did market structure. So the next thing that we're going to look at now is supply and demand section. And so we'll be looking at supply and demand section. Supply and demand is very important because when we look at the market is all about the battle of supply and demand. All right, even just the market in general, like the general market that we know of. All right, it's a battle of what? Supply and demand, meaning that whatsoever is more powerful than the other, whether supply or demand, is what is going to control the direction and the trend of the market. Okay, so in an uptrend market, let me just put some notes right here. So saying that in an uptrend market, right, we're going to say demand is stronger while supply is weak. is weak. So I'm going just to say demand is strong while supply is weak. All right. And in a downtrend market, supply is strong while demand is weak. Okay, so these are some of the points that will guide us to understand what approach we need to take whenever we are trying to look for supply and demand. All right, so supply and demand just basically basic, we don't need to even be more technical or more advanced when it comes to describing supply and demand. Okay, but just from the layman's language, supply and demand is just basically buying and selling. And we say that when supply is in control, it means that we have more sellers, all right, who are willing to sell at lower prices than we have buyers. All right, that means then supply will be in control. Okay, and when demand is in control, then we're saying that we have more buyers willing to buy at higher prices than they are willing suppliers to sell at those than they are suppliers. So in short, we have more buyers than we have sellers. So if we have more buyers than sellers, and buyers are willing to even buy at expensive prices, then we have demand in the market, and demand will push prices higher. So demand always take the prices higher, and supply always take the prices lower. So when we look at the charts now, okay, the first thing that we need to understand is that when we look at the charts, we know that market structure is the foundation of the market, meaning that a proper understanding of market structure is something that is going to elevate your trading, my trading, all right, is something that is going to make me understand where orders are flowing to. It's going to help me understand the flow of orders or order flow, all right? So in an uptrend, we know that as the market is pushing to the upside, the market will be creating what? Will be creating higher highs and higher lows, right? That's what the market will be creating. And now as the market will be creating those higher highs and higher lows, we have also stated that in an uptrend, all right, we have both demand and supply acting on this price. So we have supply, all right, and every turning point of the market implies that supply was introduced into the market. So whenever the market begins to reverse right here after price has created these highs, and we begin to see the market begin to change direction, begins to change the trend on the lower time frame, it means that supply has been introduced into the market. Now, the purpose of supply in the market is to do what? Is to remove or take out demand. So the purpose of supply here, purpose of supply is to remove demand. Okay, so that's the purpose of supply. So whenever supply comes into the market, whether that supply is to facilitate a pullback, because for the moment, for the market to start moving in an opposite direction, it means an opposite force has been applied. Like we can refer to the, is it the first law of motion, which says that an object will continue moving in its direction unless an opposing force is acted on it. All right, so it's the same law that we can apply right here. So the market will keep on pushing to the upside unless an opposite force is applied. So right here, an opposite force that was applied to this market was what? Supply. So the moment they injected supply, it could be that they started closing their buy orders after they banked on these buys and they started taking some profits. And that the taking of profits it's them closing the longs and opening the shorts. All right, because like we know, we understand in the market, because Forex is a zero-sum game. So meaning that if you're buying, there has to be a seller. If you're a seller, there has to be a buyer. So the moment they start closing their position, they're buying back their position or they're selling back their position. All right, so we know that now supply will be introduced into the market right here. And once that supply is introduced into the market, it is the opposing force to the original direction of the market. The intent and the direction of the market is to push to the upside. All right, so this force, this supply is acting against the original intention of the market. Okay, now the purpose of this supply in the market is to do what? Is to remove or to take out what? Demand. So where is the demand? The demand is right here. All right, so the moment price started buying from this low right here, pushing to the upside, demand was introduced into the market, because we know that demand is what is responsible for pushing the market to the upside, for taking the market to the upside. All right, so whenever demand is involved in the market, the thing that we expect to see from the market is to see the market begin to push to the upside. That's when we know demand is involved in the market. All right, so once supply begins to come in, all right, and that can be seen by the lower time frame. What? Maybe lower time frame order flow. Let's say maybe M15 order flow at this in this leg was uptrend, where price was creating these higher highs and higher lows, meaning that demand was still controlling, because you know buyers kept on maintaining these highs. All right, kept on maintaining these highs and kept on respecting these lows. So the moment we see that the order flow changes, so it is at this moment that we see that the order flow changes. So once we see the order flow changes, then now we begin to say, okay, supply now is in control of the market. Why? Because now order flow is bearish, and we can see that the market begins to respect the highs and taking out those lower time frame demand zone. Until now, once price comes to a level or to a demand, all right, where the orders were pumped into the market, once price comes to that area, comes to that demand, if we see the order flow shifts from being a bearish trend to being a bullish trend, then we know that demand definitely has been injected and demand has been pumped into the market. And what then this means is that the supply that was introduced at this area right here has failed to do what? To carry out its objective. The objective of this supply was to take out the demand. All right, that was the objective of this supply. So as this supply was being injected into the market, the objective, the goal, the intention was to take out this demand right here, because this is where buyers came in and pumped in those buy orders. All right, so if the market now comes to this same area, we identify that as a demand zone, all right, because that's where orders entered into the market. Now, as price comes to that area, if this supply is strong enough, all right, it has to prove that it's strong by taking out this demand zone, meaning that price should continue going to the downside and creating those lower lows and lower highs on the lower time frame, and should maintain the bearish order flow. But the moment the market now switches the order flow, instead of it being bearish like it was, all right, we see that the market now turns bullish, all right, the order flow becomes bullish. What that then means is that the demand has held, meaning that buyers have respected this demand, all right, meaning that they have protected their own orders, meaning that they never wanted these orders to go in drawdowns, okay? And also they have loaded some more buys right here at lower prices in order to do what? To push the market again to the upside, trying to protect their previous orders, which they had put, or which they had entered, or which they had placed, okay? And that is what the market always does. And this is a continuous flow. It's a continuous battle, and it happens over and over and over and over again. But it's not this easy. Of course, it comes with a lot of manipulation, as we know the market, but that's the general idea of what the market will continue doing. So the mistake that many of traders, and also I've also made such mistakes before, is to try and buy the market, is to try and sell this supply. All right.
Yeah.
So many would want to say, oh, okay, now price is coming to this supply. Let me try to sell the market. And they'll try to sell, maybe see smaller profit on the lower time frame. But then what happens? The market then turns on them and takes them out, and they remain wondering what might have happened to their orders or what they did wrong. Okay, so the issue is they did not understand that that supply they were trying to buy from, it was a weak supply. So, I mean, sell from. So we don't sell from weak supply, we only buy from strong demand. So this supply then, it has failed to take out this demand, and I mean, it has failed to take out this demand, and this demand has been respected, and we can see price now shoots all the way, taking out that weak supply, and the flow will continue just like that. Again, what we're going to identify right here is we are going to identify another demand right here, and again, we'll be waiting for price to do what? To see whether it's going to be respected or it's not going to be respected. So again, the moment we see order flow on the lower time frame shifts by the way of giving us a change of character, then we know that, okay, now sellers are trying to do what? Sellers are trying to come into the market. So now this becomes now our overall weak supply. It is weak supply because it has not yet taken out this demand. So this is the demand, this demand right here, all right? It's the demand that we can see that, okay, it has achieved its objective by taking out what? This weak supply right here. So we can say that now this demand that has been formed is what? Is a strong demand. Okay, and if it's a strong demand, then we expect this supply not to take it out. But if this supply is to be strong, as a strong supply, then we expect this demand to do what? To fail. So we expect it to be taken out also. And that's how it is. So what then will be happening is that market will begin the pullback by creating those lower time frame order flow. And if the market continues creating order flow and takes it out, then definitely we are then going to conclude that, oh, okay, so this is potentially, not necessarily that it is now confirmed a strong supply. It is going to be potentially a strong supply. Why? Because we only have a break of structure. We only have one break of the low right here. We don't have a confirmation to confirm that now that supply is holding. So what we want to see is that, yeah, quite all right, it has managed to take out this low, but then it has to prove that it's going to hold, meaning that as price begin to pull back to that area, this supply must hold. All right, it means it must hold the market, meaning that demand should not come and take it out. So as order flow begins to become bullish, and once price reaches that area, we want to see that that supply holds. And if that supply holds, then it must lead to the failure of the demand again. Okay, so that is how the market begins to move, and that's how the interaction of supply and demand is created in the market. All right, so at every time frame, you are going to see such kind of interaction. For as long as the market is going to be creating higher highs and higher lows and lower highs and lower lows, there will be such kind of an interaction of supply and demand. Okay, any questions? Or
no, that's clear. I mean, later on the market, we have to also identify where is the market turning and which demand is the right one. But I think this will come later. Yeah,
exactly. And yeah, that definitely will come later. And also, just to maybe shed or maybe touch on that aspect, when it comes to identifying which demand zone the market is likely going to use, one of the things that I have observed with experience of being on the charts for quite some time now is that if you want to pinpoint exactly which demand or which supply the market is going to turn from, I think that's a very difficult task that you may find yourself trying to achieve.
Yeah.
Okay. Because with experience, I've come to realize that nobody knows which zone the market is going to use. And this is why we have to, you can't pinpoint exactly to say this is the one right here, this is the one right there, this is the one. Otherwise, everybody would be profitable. Okay, but this is where now we begin to look at confirmations, other factors of confluence to help us now pinpoint to say this is the zone that might hold based on these factors, and we are going to look at those factors that we can bring in to help us identify which zone is likely going to hold. Okay, not that it's the exact zone. So again, going back to the aspect of market structure with supply and demand. So when it comes to supply and demand and the terminology used in supply and demand, you agree with me, since you are quite familiar with this concept. So for me, okay, my understanding of supply and demand is that, you know, all these terminologies that smart money traders have come up with, they're just one and the same. So supply and demand, to me, is the same as institutional candles, all right? And I'm trying to generalize this, okay? It's the same as institutional candles, because I don't want to really isolate them, because you'd realize that when you find maybe another instructor talking about institutional candles, you'd think, okay, what are they really talking about? All right, but you'd realize that, okay, these are candles which are also known as what? Order blocks. Okay, so order blocks. Again, you find, oh, okay, what are these order blocks? They're just like, you know, rally, base, drop, and drop, base, rally. All right.
Yeah.
Again, they're just the same. All right. Some have even gone, you know, to an extreme of calling them FU candles. You know.
Yeah. I heard about
But
this.
yeah, but if you look at all these terminologies, you know, it's just those terminologies that I think maybe they just resonate properly with their way of looking at the charts. Okay, but in the end, these things are just one and the same. All right, just one and the same. Okay, so maybe the only difference that can be there is when it comes to identifying a demand, I would look at a range, sometimes a range, all right, a range. And if price breaks out of that range, then we can call this as a demand zone, all right? Could be a range. And then when price breaks out of that range, we can call that as a demand range. So in this demand range, you can now, which others now would then go ahead and identify a what? An order block. Let's say in this demand range, all right, this is a demand range, then they'll look for the last bearish candle before a bullish move to the upside that led to the breakout of that range, and also that led to the break of market structure. And that is what they're going to pinpoint now and call it what? The order block. Okay, for precision purpose, or the institutional candle. Others, what they'll call an institutional candle is just that candle that was used to grab liquidity. After that candle grabbed liquidity, which now led to the break of structure, is what they'll go now to call what? An institutional candle. All right. So to avoid all such confusion, for me, all these, I've just grouped them in one group and category, and I just call them supply and demand.
Yeah.
Okay. Yeah, just for simplicity's purpose. Okay, I'm not here to make things complicated. Actually, my goal is to make trading as simple as it can be. Okay, so that's that about supply and demand terminologies, which, you know, many different traders have come up with to explain the same thing. You know, one man said that, you know, Forex trading is 1,000 mentors explaining the same thing in 1,000 different ways.
Yeah.
That's what the Forex market is. So yeah. So but also the other thing when it comes to looking for candlesticks, I don't know if we need to deal with that, or we can completely put it aside. and assume that you already know.
Mhm.
Okay, so when it comes to identifying the candles, for me, let's say this is a bullish candle. And prior to this bullish candle, there was, let's say, a bearish candle. There was a bearish candle. And this was, the market hit, maybe let's say, an odd zone, right? And after hitting an odd zone, let's say there were bullish candles coming down, and then price hit that odd zone, and then price immediately reversed and started pushing to the upside. Okay. For me, this is what we call a bullish engulfing, but when it comes to supply and demand, this is what we're going to call a demand zone. Okay.
Yeah.
It's going to be called a demand zone. So if price, then maybe it happens that we had maybe a week to the downside, right? A week to the downside, like in this example, we have this week to the downside. Okay. And let's say price, even this previous candle had the week, maybe a week was, say this. Maybe a week here was even shorter than the next week. Say it was even shorter like this. All right. So you can see price created this week, then the market continued and then created this lower week and then pushed to the upside. So what this would look like on the lower time frame is this week is a sweep of liquidity. All right. The sweep of the liquidity that is lying below this week. So price swept. So meaning that if we went on the lower time frame, it was something like this. Price was coming down, then swept the liquidity, then did this. Okay, so this was the week, which could be this one right here. And this week is this one. So this is more of a sweep of this low, right? By this week, then price pushed to the upside. Then it broke structure, meaning on the lower time frame, it's a change of what? It is more of a change of character. So let's say if there's another week, which is like this right here, okay, and price then creates this candle, all right? So that is going to mean that we had a change of character right here, meaning that that is a fractal change of character. All right, meaning that on the lower time frame, we had something like this. We had a high, a low, lower, high, lower, low, higher, high. That's a change of character. Meaning that the moment price pulls back into this area, we may be expecting to do what? We may be expecting to buy the market. Now, how do I then map this one as a zone? So what I'm going to do is that as I'm mapping my zone, I'm going to also include this week like this. Right? So in most cases, I'll include it, I'll map my zone like this.
Yeah.
Okay?
So both weeks for the longest, the week to the upside and also the week to the downside.
Exactly. So this is going to become the zone. Okay. I'm not just going to map this one and say, okay, this is how the zone is. No, I'm going to, because this was their last sell before they short to the upside. So I'm going to map it like this. And then if I were to refine, and in most cases, I don't usually do refinement, more especially with Nasdaq because of its volatility. All right. Sometimes it may not come to those refinements. So if I were to refine, then I'll consider refining to this week. All right. That is if I'm refining. Let's say if the zone becomes too big, all right, then if I were to choose the refinement, I'll just go to the week like this, all right, and consider that as my zone. Okay, why am I considering this as a zone? Because, of course, like we looked at, it was like this, and then price created this low, then went up, then created this lower low, then went up like that. Okay, so I would pick this to be my last sell point. This is where they sold hard, all right, to tap into this liquidity before reversing sharply and going to the upside, all right? So there will be a lot of orders here, all right, meaning that there will be a lot of sell orders which they opened to tap into that liquidity, which they would need to come and do what? To come and mitigate. So hopefully, or sometimes price may even come to that area and mitigate those zones, and then continue or reverse and continue in its original direction. So if the zone is quite too big, I would go for the week.
Yeah.
And just that week like that. Okay. I believe it's something that you also do.
Yeah, I know this.
Okay. All right. And the other one is oh, okay. Wait, just a moment. Okay, so the other one is an example of, because there will be different types of candles that we are going to be looking for to mark as our zone. So the other one is where, let's say we had a bearish candle that came down. All right, the market was bearish, and this applies both to the upside and to the downside. So I'm just going to use one example to cater for both. So we have a bearish candle, which is like this, and then price opens and gives us an inside bar. Okay, so price then opens and give us an inside bar like that. And it's a bullish candle. All right, so this is what we call an inside bar, and it has to be the high and the low of that candle must be inside the previous candle. So something like that. So let's say we have this inside bar and price, of course, continue going to the upside, right? Let's say price continues even printing, it also even prints another, candlestick, which can even, go all the way to the upside, and maybe it also has the wick. Yeah, and this is kind of a setup. This is a vessel. All right.
Yeah.
Now, when it comes to mapping the zone, obviously, you would look at this to say, okay, this is where we broke that candle. All right. This is where we traded above that candle. All right. So if you were to identify the zone, all right, obviously, if you were to look at that from that angle, you would look at this to say, my zone is going to be like this. Right, that's a right way of identifying a zone, of identifying a demand zone. All right, but again, you also need to look at, okay, this zone is quite too big.
Yeah,
right, quite too big, meaning that your stop loss is going to be very huge unless you use a 50% entry. Right now, if you identify that there's an inside bar, all right, you identify that there's an inside bar. So instead of picking all this big zone right here, instead of picking all this big zone right there, what you're going to do then is that you are going to focus on an inside bar, which is this one right here, right? You get this candle, and also if it is engulfed, if that candle is inside, the high and the low of that candle is inside the previous candle, then you're going to take the low of the previous candle and the high of the next candle to create a what? To create a zone like this.
Yeah.
So that's how we are going to do it. Okay, so you get the high of this candle and the low of the previous candle, and you can map your zone like that. Okay, and this is where now, this is the right way also, and be expecting price to come here and, to see those nice buying opportunities, more especially if the next candle was such an impulsive candle and it left an imbalance. Okay, then that is even going to be a good zone to look for some buying opportunities. So this is how you're going to map the zone for a candlestick that is going to create your inside bar pattern. Okay, now the other type, okay, and this example now I'm going to use maybe some bearish examples. So the other type of a candle is where we have a pin bar. So let's say a pin bar, it could be bullish, it could be bearish. The color of a pin bar is not so much of a factor. It could be green, it could be red, okay, depending on the color of your candlesticks. But what matters most is to understand where that is happening from, all right? Because where this happens from is more important than just a mere pattern. All right, so we're not just more interested in a pattern, but we're interested on where that pattern is happening from and the message behind that kind of a pattern. So we can see right here that we had this rejection, and rejection, when we go on the lower time frame, what this rejection may mean is it may mean a bearish engulfing, meaning that what we're going to have is we had maybe how is it going to be in this situation? If it was red, it would mean a bearish engulfing, all right, if it was red. But if it is green, it may mean an inside bar, which is a bearish inside bar, all right, where we have a green candle, okay, like that. Then we have maybe a bearish candle, which is just inside like that, okay. So if we have this bearish candle like that, all right, then if we add these candlesticks together, we are going to produce, okay, we're going to produce this kind of a pin bar right here, because once we push this candle inside here, all right, inside here, we are going to have this kind of a pattern, okay. So if it's green, it means that it was more of an inside bar. It was more of an inside bar if it is green. But if it is red, then it is a bearish engulfing. You understand?
Yeah.
Okay.
Makes sense.
So, okay. So, oops. So now, after we have this, okay, there are two ways again of how you can map this as your zone, right? There are two ways of how you can map this as your zone. So the first is, of course, you're going to consider from that high all the way to this low and map it like that. And you can use a 50% entry for this zone, right? If it is too big, you can use a 50% entry. Okay, it's going to be fine. The other method that you can use to map this zone is where you just take this, all right? You take the wick. That is if the wick is too big. You can just take the wick. What does that wick mean? It means there was a buy before the sell. So there was a sharp buy. It could be maybe the buy that even dipped into liquidity right here. Let's say there was some kind of equal highs or maybe an odd high, which price, took out, and then after taking out that high, then price reversed completely and started pushing to the downside, leading to the break of structure. Then you are going to consider this as your zone. All right. So if you can't take the whole range, which is the whole pin bar like this, all right, and look for 50% entry, then you can just refine it to here, and you can take your entry just right at the, let's say, at the close of that candle. So you take your entry right here if that is a green candle. But if it is a red candle, then at the open of that candle, that's where you can take your entry. Okay, so this is an example where you're dealing with a pin bar. Now we also have an example where you're dealing with a doji. So a doji is more or less like a pin bar. So you just can also, if you're dealing with a doji, let's say this is a gravestone doji, and the gravestone doji, we know that it's a bearish kind of a doji. So we have a gravestone doji like this. So if we are dealing with a gravestone doji, then what we'll be dealing with, or what we'll be considering, like again, I said, it's a position that matters most. So in this example, we can also again cover the whole entire doji, All right, let me use a different one. So we can cover the whole entire doji, that is from that high all the way to this low, and take that one to be our range. And we can enter at 50%. All right, we can enter at 50% of that entire doji. Right, because we know that a doji is an indecision candle, and if price continues going to the downside, leaving the doji as a zone, and we're going to cover it, can pick it like this. But again, if it becomes too big of a zone, then we can just reduce it to at least here, okay, where the candle, where the doji closed, and we pick that wick to the upside. Or if it is a dragonfly doji, then we pick the wick to the downside. Okay. All right. So there will be different candlestick patterns that we are going to encounter. And let me just give the last one is a fractal supply and demand. And this one is where price is pushing. Let's say price is pushing to the upside. And then we have a wick. Okay, we have a wick like that. And then again, the market opens right here and continues to the upside. And also again, we have, let's say, a wick again like this. So what we have right here is what we call a fractal. So if this kind of a fractal refinement or fractal supply and demand happens at a point of interest, more especially maybe if price was reacting to an odd supply. Let's say there was an odd supply right here, right? There was an odd supply which was not mitigated, or an odd demand which was not mitigated, all right? And price hits that area. And then we see this kind of a pullback or a reaction with that zone. It means price had collected the orders before pushing to the upside. So this area then is going to become what? Our zone that we are going to consider taking the orders from. All right. Should price pull back to that area, and of course, we'll be looking for a nice confirmation right there in order for us to take the orders, because we can't just enter the market directly. We don't know whether this area is going to hold, or it's going to fail, or it was just put there in order to generate enough liquidity for the market to even come lower, maybe to a more reasonable demand for some nice buying opportunities. Okay, so that is an example of a fractal. And also the other, where you can consider taking this zone is if it lies, all right, in our nice zone where we are looking to buying the market. Let's say price has been pushing all the way to the upside, all right, and it lies in the nice area, all right. It lies maybe, let's say, in the oversold or overbought region of the market, or it lies in the discount or premium region of the market, meaning that if you put your gun box from the low to the high, and you realize that, oh, okay, we also have a fractal right here, all right? So this is going to be one of that hidden supply, hidden demand zone that you may consider also marking, all right, for price to come and, retest. Okay, so price may come.
Yeah. And we would only take this one because the other one is in the premium area where we would not look for buying.
Exactly. Yeah. So if this one now finds itself in a properly priced range, then we'll look for it. Okay, we'll look for buying opportunities right here. Okay, so these are some of the patterns that you are going to find and you are going to work with. Okay. Yeah, because it's not, we cannot take every zone that shows up on the market. We can't just do that.
Yeah.
Okay, in as much as we would want, but we can't just take every zone that happens to show up on the market, because we need to abide by our rules and we need to follow our rules, because, you know, as we know, the market doesn't have rules. It's us traders who create the rules for trading. All right. Now, let us now continue and look at the two types of supply and demand patterns that we are going to be looking for. All right, the two types of supply and demand patterns that we are going to be looking for. So let me just write them right here. So you can say two types of supply and demand patterns. Okay, so number one, we have reversals. And under reversals, what we have drop, base, rally. And then we're going to say this is a bullish pattern. Bullish pattern. And then the other one that we're going to have is a rally, base, and drop. And this one is going to be a bearish pattern. Okay. By the way, the trader has hit my take profit, so we're out.
Oh, that's good.
Yeah. So number two, we have continuations.
Yeah.
And under continuation, we have rally, base, rally. And also we have, so a rally base rally is bullish continuation. So it's bullish continuation. That's the cont, and then like that. So bullish continuation. And then the other one that we have is a drop base drop. All right. And this one is going to be a bearish cont. Okay. All right. So now let's begin with our reversals. Now, with the understanding of market structure, all right, this is why I strongly recommend somebody to master market structure. Okay, with the the understanding of market structure, draw it nicely. So we have a push, then we have some kind of a reversal pattern right here. Then we also have some kind of a reversal pattern right here. And then we create that high, which is also in the process of pulling back. Okay, so we end there. Okay, so what we have right here is, number one, we have a break of structure, which is quite important, right? So break of structure, and we can see we have a confirmation. We have a low, a high, a higher low, a higher high. So it's more of a bullish confirmation. It's more of a bullish trend right here. Okay. So now, what does it mean to have, what does it mean by a reversal pattern? How do we identify a demand zone, all right, in what we call reversal pattern? So for a bullish reversal pattern, you can see that price has been pushing to the upside. So this is called a what? A rally, right? Yeah. This one is called a rally. So we have a rally right here. Rally. Now, as the market rallied, it created a base, which was a weak supply. So this is a weak supply. Remember, in an uptrend, supply is weak, demand is strong. And then after that, we created a drop. So we have a drop like this. Okay, a drop. Okay, so now after we have a drop, the second thing that we need to see is what? A base. So we are dropping, then we are creating a base. So which one is our base? The lower high is going to be a base. So the lower high that is going to be created is going to be what? Our base. And that is our demand zone. All right. So this one becomes the base. And it is the demand zone. It is the extreme demand zone. All right. And then what are we going to have after the base? Then we're going to have another rally. Now, in this situation, in this case, the rally must lead to the break of structure. So in an uptrend, a rally must always lead to the break of structure for the base to be a valid base. Okay, so we had a drop. A drop never led to a break of anything, right? It was just a pullback. So we had a drop, a base right here, and then a rally. All right, so drop, base, rally, bullish pattern, meaning that the moment price comes to this base, what do we expect to see? A buy. Get it? So we expect to buy the market. So now price again will create that rally, a weak base on top, then it comes down to this strong base. And then again, what happens here? It has to give us a base again, and then price pushes to the upside. Okay, so again, it's a cycle, all right? So the cycle will continue itself. So we have another break of structure right here. So we can call it BOS. And then we have, again, a drop right here. And we are going to have a rally. We're going to have a drop right here, which is drop. And then we're going to have a base. So this base has already been touched. Price has already collected the orders, and it created another base, which is what we call a demand chain. So we have now a base, a new base. And the next thing that we see is price should do what? Price should rally. So we have a rally right there. And a rally leads to the break of structure. So this is a continuation, and price will keep on doing all those things. Now, the most important thing about this is that we have a weak base and a strong base. All right? We have a weak base and a strong base. So this is also a base, but it's going to be called weak what? Weak base. All right? Because it is a weak supply. This one is going to be called a strong base. So strong base, because it's a strong demand. So even right here, we can say strong base because it's a strong demand. And then this one is going to be called a weak base because it is a weak supply. All right, we can see we are dropping, but this drop is not leading anywhere, but the rally is leading to the break of structure. Okay, so that is an example of what? Of a bullish reversal pattern. Drop base drop. Drop base rally. So price drops, creates a base, rallies, breaks structure, drops, then it comes to that base, mitigates that base, all right, rallies, breaks structure, again drops, comes to that strong base, rallies, breaks structure. For as long as the market remains in a bullish trend, that is what the market is going to be doing over and over and over again. So the pattern may vary, all right, depending with what the market wants to do and what the market makers want to do, but the patterns may vary, but it's the same thing that the market would do every time from eternity past to eternity future, all right? It will never change its way of performing, right? So now let's look at the other one, which is a rally-based drop. So a rally-based drop is an example of a bearish what? Of a bearish market. So we have a drop right here, then we have a base right here, which leads to the creation of a rally, and then that rally creates another base, which leads to the creation of a drop. Okay, so at this point and at this moment, what we have is we have a confirmed trend. So again, a confirmed trend is very important because in a confirmed trend, what we're dealing with is we have two lows and two highs, which is quite important. So right here we have a weak, it's a base, but it's a weak base. Remember, in a downtrend, supply is what? Demand is what? Is weak. So we have a weak base, all right? And supply is strong. Okay, supply is strong. So here we have strong base. All right, now we can see that we had a drop right here. So we had this drop right here, which was the initiation of the market. So drop, and then we had a base, which is a weak base, which led to a rally, So now we have a rally, right? Now this rally, it's a weak rally because it doesn't lead to anything. All right, doesn't lead to anything. It just leads to the creation of a new base. Now this new base results into a rally, which leads to the break of what? Of structure. So this is now a rally which leads to a break of structure. So after we have this, what do we have? We have a strong base, meaning that as the market continues creating such kind of patterns, all we'll be looking for is to be selling from what? Strong base. So price go back to that strong base. All right, it mitigates that strong base. Again, in the process, it gives us another base which leads to the break of structure. So again, we go back to the similar process. We have a rally right here. We have a rally. Then we have a base, which is right here. Okay. And what are we going to have? We have a drop. Oh, okay. I wrote two rallies. Supposed to be a drop. So we have drop, yeah. We have a drop right here. All right. So even here it was supposed to be a drop, not a rally. So we have a drop. Okay. So this is what is going to happen. And again, this drop will lead to the break of a weak base, which was this one right here, which was created as a result of a pullback where price started pulling back, and it will eventually also lead to the break of what? It will eventually also lead to the break of structure, which is right here. And this is how a reversal happened. All right. Now, this, like we've always been saying, that if the market was this easy, I think everybody else, we would all be billionaires by now. Right? Everyone would just say, oh, you know what? I won't be working for anybody. I'll just become a Forex trader. And in 2 months, I'll be a billionaire. And everybody would be moving the market, would all be moving and influencing the market. But it's not that easy. All right? It's really not that easy because of how the market is manipulated. Now, having this information helps us to know and to have a bias in the market, knowing that the market is always going to come back to these areas for what? For mitigation. Knowing that the market always come back to these areas for mitigation. If the downtrend is to continue, and also to the lower highs if the bullish is to continue, and on and on and on and on and on until one of these areas fails to hold. That's when now we'll start thinking, okay, maybe the market will go into another direction. Who knows? All right. But for as long as these areas are still holding, we'll be looking forward to seeing the market continue in that particular direction. All right. Now, like we said, it's not always the case, meaning that in this range right here, all right, in this rally, this leg right here, right, which creates a rally for an uptrend, right, in this leg right here, which is a swing leg, right, and in this leg here, which is also a swing leg for a downtrend, there will be a lot of things happening. All right, there will be a lot of things happening, and those things that will be happening in this leg will affect price movement and price behavior. You get it?
Yeah.
And those things that will be happening in this leg right here is what will cause price not to come to this area. Right? Is what will cause price not to do what? To come to this area. So there are so many things that may facilitate the creation.
That means price will form some other zones or some other areas where it can react from inside this area.
Exactly. Exactly. So price may form other zones inside this range where price could react from to do what? To create a higher low and go to the upside. Okay, but the overall objective is for price to come back here. So the objective is for price to come back here. That's the objective. This is why for those guys that trade, you know, supply, pure supply and demand, they'll call it failure to do what? To return, FTR.
Yeah.
Right? They'll go failure to return, and they'll consider that to be what? Liquidity. Because now the demand that they had identified, price never came back to it. So it's an FTR, failure to return, and they'll call it liquidity and give it different names. All right. But you know, sometimes it's okay to think in those ways and all that. And also sometimes, you know, no one knows the market very well. Okay, nobody knows the market very well. So the only thing that we need to do here is to become open-minded and become flexible enough to know the things that we are doing are not working. Okay, so now what is going to prevent price from reaching the extreme zone? All right, so one thing that should always be at the back of your mind, and this has really helped me to remain objective when it comes to the market and to remove that fear and just be okay, I'm looking at the market objectively and not subjectively, is the fact that once I identify a trend in the market, all right, once I identify the trend in the market, if I see the market creates a higher low and a higher high, all right, and I identify my zone, okay, I identified my extreme. Let's say I'm just dealing with the reversals. One thing that I'm sure about, and you should also be sure about, never doubt this, all right, unless it doesn't happen. But even if it doesn't happen your way, don't ever doubt it, all right, is the fact that this is the strongest level. It's the strongest of all the zones that you are going to mark in this range, from this low to that high before the pullback, because the zones that you'll be dealing with will be in this leg right here. Okay, those are the zones that you'll be dealing with, and in this leg, you also now substitute certain zones and focus on the zones that are below 50%. You get it? So now you'll be looking at those zones that are below 50%. So zones that are within this range, from that high to this low, all right? These are the zones that you'll be focusing. Any zone here, all right, will be your high probability zone. The highest probability being this one here.
Okay. Makes sense.
It makes sense, right? Meaning that these other zones that you may identify, even if they fail, you don't have to be, you know, where you become so confused and you develop, you know, heartache and all those, you know, psychological pressures. Just know that these zones are important and necessary, and they will influence the formation of a higher low of the market, but they are susceptible to failure. And if they fail, it doesn't mean that I have now to just sit on my hand and let the market do what it wants and go. No. As long as the market has not violated this zone, all right, this is the flow of the house. This is the foundation of the house. So as long as that foundation is still intact, opportunities in the market are still there. You get it? Opportunities in the market are still there until the foundation goes. If this foundation is destroyed right here, then there's nothing that you can do but to wait for what the price is going to tell you next. Because then you'll be thinking, okay, so this demand zone has failed, meaning that we have even broken structure to the downside. Now, if we're broken structure to the downside, I'm open to both buys and sells, because it might be a sweep of liquidity right here and the mitigation of an unmitigated zone and a continuation to the upside, or it may be the reversal of the market beginning to do what? To form. You get it?
So when you see this zone as being broken, then you have to see first what does the market next. You
Yes,
can't just
exactly.
trade, but you have to see what is the next move that shows.
Exactly. Exactly. So this one is your decision point. All right, where now you say, okay, what am I going to do now? Okay, so this zone has failed. Okay, let me see what the market is going to do next. But if any zone below your 50% fails, let's say there was a zone here and it fails, don't have to worry so much about it. If there's another zone here, fails, all right, wait for this one to fail. That's when you can say, okay, now I think the market doesn't want to go up, it wants to go down. Then you can now say, okay, I think I've tried and it has failed. Okay, but if this one fails and this one fails, price could be coming for this one here, and then giving you buys. Okay, and your buys are still valid. Okay, so now having this information and understanding, I then now began to think to say, okay, when it comes to identifying any zone here below the 50%, these zones, I'm going to give them the probability of 50, meaning that I've got a 50% probability or chance that this zone is going to work. I've got a 50% chance that this zone is also going to work. And I've got 100% chance that this zone is going to hold.
Okay.
Yeah, that's now my thinking. Okay, that's my thinking. Why should this zone hold? Because this is the strong low, and that's the weak high. They don't have to run these orders right here. But any zone within the range, they can violate them in order to do what? To generate liquidity in the market, in order to come and run that liquidity inducement, come to this zone, then push to the upside. You understand my reasoning now, right?
Yeah.
So, but the other thing is that these zones and whatsoever happens, all right, may prevent price again from coming here. It may prevent price from coming to this extreme one, which is the most strongest. So if price now is pulling back, it may now react on this one, give us an change of character, confirmation, and price pushes back to the upside, meaning that this zone will remain unmitigated. All right, it will remain unmitigated, and we don't know how long orders may still be remaining there. But if price then comes down, all right, and it is coming down and it breaks this one, all right, so again we have two things we are thinking about. Price could be coming back to this unmitigated zone right here, get the orders, and then push to the upside, continue with its original trend, or use this zone as just for a pullback. Now I've gone ahead of myself. Now let me explain them slowly by slowly with clear diagrams so that you may also understand what I'm trying to explain. Okay, so the next type of pattern that we're going to look at are continuation patterns. All right, continuation patterns. And continuation patterns, these are now what we call rally-based rally or drop-based drop. All right, so these are the continuation patterns. Okay, so let me just delete this and remove that. So remove this. So now, continuation patterns will be like this. Price pushes to the upside, creates that high. Then we have, of course, we are going to have our rally-based drop and drop-based rally patterns. But also at the same time, we're going to have these continuation patterns, which are rally-based rally. So let's say we have one here and price then pushes to the upside like that. So let me just extend this so that we can have it lower. Okay, so this is an example of a confirmed structure that we have, and we have a break of structure right there. Now, after we have a break of structure right here, then we have a drop-based drop. I mean, a drop. So we have a drop right here, drop right there. Then we have a base right there. Okay, I'm going to call it a base. Then we have an overall rally. Why am I calling it an overall rally? Because it's a swing leg, right? So yeah, so it's just a swing leg. That's why I call it overall rally. So let me just put overall. Overall, can say overall rally. Now, as we are having this overall rally, you can see that we had a rally before price paused, and then again it rallied. So this is also what we call now a what? A rally and a base and a rally. So we have a rally. Inside that big swing, one swing, we have another internal structure, which is now going to be a rally, base, rally, right? And we have this, which is going to be our rally. Okay. And this rally here could be a reason why price may not reach the extreme. So this one is going to be a strong base like that. And the other one, we're just going to leave it like, just leave it as a base. So we have a base and a strong base. We know this should not break, all right? This is our last hope. If this one fails, this one is our last hope. Shouldn't fail. Yeah. Okay. So
in this case, we would also consider this one here as the zone that broke the structure.
Exactly.
Okay.
It happened before the break of. That's why I've put it deliberately there. Okay. I wanted to put another one, but at first I put it there deliberately so that I may now explain the points clearly. All right. Because again, it's all about looking at the relevance and the positioning of a zone. Where is it found? Okay. So here, this is the origin of the move, origin, which led to the break of structure. Right? Yeah. That's very important. Origin of the move, which led to the break of structure. This is the reaccumulation, which also led to the break of structure. So both zones led to the break of structure, all right? But this one is the origin, right? Meaning that it's the strongest of them all. Why? Because it's a foundation, right? If you are building a two-story house, a two-story building, of course, the foundation has to be stronger in order to hold, those stories that you're going to put on top, right?
Yeah.
Yeah, same with this. So this one is strong, even if it did not directly lead to the break of structure. You get it? But it is sustaining this one here. Okay? Which then eventually led to the break of structure. Okay. So as price now begins to pull back, all right, this could be one of those reasons why price could come and, turn from this area and give us a base right there. And then the market would also again go and give us that zone, then push again, come back to another zone, and then price pushes like that. So what we have right here is now we have a reason not to only consider price coming to the extreme, but also to look for opportunities within the range. All right. So price may not only come to this area or to this extreme, but to also be looking for opportunities within the range for price, for buying opportunities to come. All right. And this is where now price comes. And of course, when it comes to trading a zone within the range, all right, which is not, of course, the extreme, always look for confirmation. So here, all right, unless you are a risk taker like me, where you can just take an aggressive, you're ready to lose, your risk, your risk management, well, your risk percentage, then you can be an aggressive taker where you can take that trade without confirmation. But if you're that kind of a conservative trader, then you have to always, okay, it's a good spelling, always wait for confirmation here. Always do what? Wait for confirmation. Because why are we waiting for confirmation? It's about the validity of this zone. All right? It's valid It's valid, but its validity is not as strong as this one here. All right. Here, you need to wait for confirmation because, of course, who knows whether it's going to hold or not. The fact that it's there doesn't mean that it's going to hold. You get it?
Yeah.
Yeah. So you now need to start thinking in those lines. So, okay, the fact that it's there doesn't mean that it should hold. All right. It means that they may just put it there to generate liquidity, like, triple lows. You understand? For price to come and run those lows, okay, and get into these areas, and then price pushes to the upside. So when we bring the aspect of liquidity, you then understand that, sometimes these zones, they may just be there for the purpose of generating even enough liquidity for price to even pull back lower into those much discounted price levels for buying opportunities. But also at the same time, it can hold. Like if they decide to use this one, then we only want to see order flow shift, because as price was coming here, obviously it was in a bearish order flow. So once price gets there, we want to see our change of character, our shift, which could also be a Quas model. And then we get into a zone right here, buy, then price hits its way to the upside, and we target the next available previous high, which is this one, as for a target profit. And this could be the reason why price may never come back here and mitigate this. And this is going to cause this zone to remain unmitigated. All right? It's going to cause that zone to remain unmitigated. And then again, as price then pushes to the upside, we are going to have, again, the same thing, another rally-based rally and another rally-based rally like that. So right here is we have a pullback right here, and we have negated the market at the price. So what do we have? We have a drop, a base, and a rally. So we have a drop right here and a base. Let's hope I'm not too slow for you.
No, it's okay. It's okay. I think it's very important to get these things absolutely correctly, so we can use them the right way later on.
Yeah, exactly.
This is sometimes it might seem a bit boring. It's like the market structure, but it is very, very important to get these things correct.
Yeah, exactly. Yeah, exactly. Very much true, because these are the basic, like I said last time, the secret is in the basics. Yeah, so once you master the basics, then you're done.
Yeah.
Okay? Yeah. So again, what we're going to have right here is we have a rally, and then let me just put all these things together. So we've got all these rallies, right? And we're going to have bases. So again, we're going to identify base right here. And now this base, you can see it is formed before the break, and there's one which is formed after the break, right? So in this situation, the question comes in to say, which of these two bases are you going to look for? Because both are found within the range, right? Within this low and that high, within the swing leg. Okay, so which base are you going to choose? So in this situation, the highest probability is the extreme one, followed by this one, then this one is the weakest, right? And why is it the weakest? It is only going to become strong if it was formed as a reaction from the odd zone. Let's say price may have left a zone right here, which it never mitigated. So we have a zone right here, and price never mitigated, never came down to it. Like, what happened here, these zones, and I'll explain in the next session why this is important. Oh, not in the next session, in this very session, all right, why this is important. So if price leaves a zone like this, all right, like the way it has left this one, okay, the next time it will come back to it, it will just be used more of a reaction zone, right? It will just be maybe a reaction for a pullback, etc., etc., and that's it. We don't expect a big move or a huge move that may even lead to a reversal. Okay, at best, we may just expect a small move that may just lead to maybe a pullback. So this zone can only be valid if it was created after the reaction. All right. So if price comes, collects orders here, reacts, then pushes. That means here there was a supply to demand flip. So let's say if this was a supply that was not created, price hit this supply, pushes to the downside, then demand takes over. This is what we call a flip of the supply. So we flipped this supply by the demand which came in. And again, flips, they're just all the same. It's just where the reaction takes place. So flips are more of demand reacting with supply and one of the two winning over the other. You get it? That's what creates a flip. And I'll explain it also as we proceed. But they're just more like continuation. All right? They're just more like rally-based rally, drop-based drop. Except that with them, there is a reaction to something on the left, to an odd zone that was not mitigated. Does that make sense?
Yeah, absolutely.
Okay.
Yeah.
Okay. So, so we have these three, and of course, price may come to any, either here, of course, it's possible, but it's the lowest probability. If this one fails, price may come to this one. At least it has got a higher probability, or these two can both fail and price can come here. And this one is the one that is going to have the highest probability. So in order to take your trade on this one, right, this is where now you bring in the aspect of the what? Of our gun box. Remember our discount versus premium too, because now you want to pick which zone is properly priced. You get it? So now this is where your gun box come into play, and you look, okay, so this one is already overpriced. We don't have to look for it. You cancel it. Even if price came here, it's not the zone that you're going to pick. It's a zone that you have to completely ignore. At least this one is properly priced because it is found in our discount. So you may even be thinking to say, okay, I'm going to look for a confirmation right here and buy the market. If there's no confirmation, because sometimes it may give you a confirmation and then it does this, meaning that you just became part of liquidity.
Yeah.
Again, you didn't know that. Yeah, you understand? You didn't know that that would happen. You didn't know that you were going to be liquidity. But yeah, it happened. And you don't have to be hard on yourself. That just happened. It's part of the market. Then price may even come here, now give you a proper change of character, and price then gives you that nice win that you were anticipating to get. All right. So even this can fail, and this one is going to hold. All right. So yes, sir.
Yeah. All right.
Okay. So we can just, I believe with this, you can just look at it from the flip side and consider it to be supply instead of me having to explain the same things with a flipped chart. So it's just consider it like this. So it's just one and the same thing. Okay.
Yeah, that's okay. That's yeah.
All right.
All
Okay.
right.
So and that's what is important about our supply and demand zone. Now, the next thing before we look at what we the last item on this supply and demand is we need to always come up with like I said, we need to always come up with rules that we are going to use for our trading. So in our last sessions that we looked at, we had 3 rules that we were looking at. So we said rules for trading. Now these are rules for trading. So number 1, we said we want to have a confirmation, a confirmed trend, right? So confirmed trend, that's what we are looking for, meaning that we are looking for how many? 2 highs and two lows. Okay. Number 2, we want a recent break of structure. So recent break of structure, okay, which is a BOS. Then number 3, want pullback into the discount, okay, for a buy or premium for a sell. Number 4, then identify a supply, or can say properly, identify properly priced supply or demand zone. And then number 5, zone validation, which is a change of character. So change of character. Okay, so that's a zone validation. So we're only remaining with, I think, two rules, and that is about much of it is about inducement, is about liquidity and imbalance, which we're going to cover so much once we start looking at liquidity. Okay, so going step by step, we started with the 3, where we said confirmed recent break of structure, pullback into what? Into a discount for a buy or premium for a sell. And then now we've added 2, which is identify a properly priced zone. That is a zone that is found either in a premium or a discount. And then we need to validate that zone by a change of character. All right, so these are the rules that we need to live by, follow, and it's not like you have to really begin to write them down. They'll come to you as second nature the more you work out the market. So you don't have to start, cracking your head to say, oh, what is rule number 2? What is rule number 3? No, it comes just as second nature to you.
Yeah, I think you have to adhere to them all anyway. So it's not like you learn them rule by rule, because you need them all.
Yeah, you need them
every time. Yeah.
Yes, every time you need them all. Okay, exactly. So we have our break-off structure here. And the next thing that we're going to do is we already have a confirmed trend. Let's assume we already have a confirmed trend. So the next thing, confirmed trend, recent break-off structure, then the pullback into our discount. So we take our gun box, and of course, we are going to only have 2 zones which are found in our discount zone, which is this one right here and this one right here. Okay, the extreme. So these are the only 2 zones that we're going to have. And of course, we will be waiting, like I said, the first one, the zone that is found within the range, you only need what? A confirmation. So confirmation, if that holds, then price should continue pushing to the upside. Okay, so sometimes price may overextend, and once price overextends, what's the next thing to do? Again, we go to the same, we repeat the process. Break of structure, the trend is already confirmed, we're uptrend, so we have a recent break of structure. We go again, take our gun box, and then we put it right here. Then the third rule is, the fourth is identifying the zone. So we identify this one as a nice zone right here. And we also identify this one as the extreme zone. And we wait to see where price is going to be. Now, you're going to find yourself with this situation. The question is, are you going to consider this? Because this one is almost at the 50%. So do you take this zone? It is up to you, right? It is up to you whether you have to take it or you're just going to stick with the zones that are found in the premium, in the discount.
Yeah,
right?
yeah.
Yeah.
Sometimes you have the situation when the trend is very strong that you don't have the reaction from a premium or discount zone, but you have it at a higher zone.
Yeah.
Something like when price pushes very strongly to this side, then you don't have price going to the discount, but you have to react from somewhere here, and then
Yeah.
again here, something like this. So I think it's, I mean, you normally you would not look for a zone in the premium like this one, but you have to look at the reaction at the zone anyway, as we
Yeah.
have the zone validation here in the
Exactly.
rule number 5. So yeah, I might, if I see something like this, I might consider it, but I would
You might
definitely
consider.
wait for really proper confirmation for this one.
Exactly. So might consider it more, especially with when you understand the fractal nature of the market. All right. So when you understand the fractal nature of the market, you are going to, if this move, all right, is also valid on the M15, then you're going to consider this as your M15 structure, and you can still pick a trade right there. You get it? On M15.
Yeah.
You can still, because on M15, it's a valid structure, this one. Okay, meaning that I hope you understand what I'm talking about. Meaning that in M15, if you took your gun box like this becomes a smaller range on M15. Okay, so in a situation where price doesn't come back down here, it may hit this area, all right, and pushes to the upside. Okay, so meaning that if we were waiting for price to come down all the way here, we would have missed this move.
Yeah.
You get it. So again, on this one, this is where now you go on the lower time frame. Let's say M5, you start looking for change of character around that area for confirmation to buy in the market, because all this is a structure on its own. This is lower low, I mean higher low, higher high, higher low, higher high, higher low, higher high. You see, higher low and higher high on lower time frame. So it's structured lower time frame, and price must respect it in order for it to go up. So then if it fails to respect this one, if it breaks this one, then what we are saying that on the lower time frame, even if on the higher time frame it can appear as a zone, but on the lower time frame it will be structure. That's where fractal comes in. So what appears to be a zone like this on the higher time frame, it is actually structure on the lower time frame. And this is where now fractal refinements come in.
Yeah.
Okay. And we'll look at that once we start looking at the actual mapping of supply and demand on the charts. That's where now we begin to look at the fractal refinements, how now you can take advantage of this as a buy if price were to come down here, because you know on M15 it's valid structure, and you are expected to start looking for buying opportunities presented on the lower time frame. Again, you have a change of character for confirmation that price is going to hold right here. It makes sense?
Yeah.
Okay, great. Yeah, so now price can, like, yeah, from just continuing with our example, price then can come right here, and then after it comes here, then if it decides to go up, it can go up, or sometimes it can even decide to push to the downside, take you out, and then the market continues going to the upside. And this is going to really help you to find out which areas and which zones that you must specifically focus on when it comes to mapping your valid demand zones and supply zones for your maybe trade setups and also for your trade entries. Now, the last on this theory side of things is when we look at the market, like I said, when we begin to look at supply and demand, there are reasons why the market is not going to come back to the discount. So let me just add something here. Reasons why price may not mitigate extreme zones. Okay, so number one, we say continuation zones within the range. Within the range. Number two, there are only two. All right. Or can even put three: imbalance, reaction from imbalance, which is also known as fair value gaps. Just one and the same thing. Then the third one is sweeps of liquidity. Okay, so most cases, if price reacts on this one, sometimes it may be a reaction on a zone within the range and the sweep of liquidity. All right, so what does that mean? So price pushes to the upside, then it comes down. Let's say it was coming down, and then price begins to push up like this, and then price, then as it is pulling back, it sweeps liquidity right here, then changes character, comes and pushes to the high. So it sweeps this liquidity, all right, which was here, and then after price sweeps it, then it gives you a change of character right here, and then price can come into this area, and then you can look for a buy and then push the prices to the upside. Okay, so maybe sweeps of liquidity, after price sweeps liquidity, then it can give you a change of character and then pushes to the upside. Okay, and then the other one is where price reacts from what? From a zone within the range, like the one where we said if this is a zone, price may come and give you a change of character within this range and then pushes to the upside. Sometimes you may have a zone right here, all right, and between this low and this zone, there is an imbalance.
Yeah.
And price may just come, react off that imbalance, give you a change of character, and then pushes to the upside. So these are the many reasons, or the two, or there could be many reasons. Sometimes, you know, price would react off of a mitigation block. It will react off of a breaker block, all right? There's so many other reasons, and we're going to look at them as we begin to look at this practically, okay? But there'll be so many reasons why price may never pull back to your extreme zone to mitigate the extreme zone. But on all these zones that are going to be found within the range, all right? So I don't know if it's okay. Let me just maybe give it to you. I don't want to give you a lot of notes, but let me just give it to you. So zones that are going to be found within the range, or areas of interest within the range. So areas of interest, okay, within the range is number one. We have continuation zones, which is we know we've got continuation zones, which is okay, continuation zones. Okay. Number two, we've got imbalance. Number three, we've got breakers. Number four, we've got mitigation zones, right? And number five, we've got sweeps of liquidity. All right, so these are the areas of interest within the range. We've got continuation zones, which are rally-based rally, drop-based drop. We've got imbalance, we've got breakers, all right? We've got mitigation zones, and we've got sweeps of liquidity. So price can react on any of these. And if price reacts on any of these,
yeah, but if you mark up all of these, then your chart is filled with all the zones.
Yeah, so now how do you identify this? This is where your premium and discount too comes in handy. You get it now?
Yeah.
So
Yeah.
now you're going to look for is, you're just going to look for areas that are below the 50% or above the 50% for a sell. Okay. And that way, these you just know, okay, like I said, it's these things, you just have to know them, that okay, because of these things, you don't have just to be oblivious of their existence. You have to know, you have to know them, that they do exist and may affect. All right, it's just something that is automatically at the back of your mind. All right, not necessarily that you're going to be marking them, but you are just aware of their existence, such that when price hits that area and turns from that area, you won't be so much shocked to say, but what happened? I was waiting for price to come down here and it never came. I don't know why price does this sometimes. You know, when I'm expecting for the market to come down, it doesn't do that. No, when I want to buy it at a different zone, then price breaks it and comes at the, so you just have to know to say there's one important zone, which is the extreme zone, but price may not come to the extreme zone because there are these other factors within the range that may hinder price from coming down. And what are those factors? Oh, there are continuation zones. There's imbalance, can also affect price. There's breakers, can also affect price. There's mitigation zone, and there's sweeps of liquidity. Then once you understand that, oh, okay, these are factors that may prevent price from getting to the extreme zone, then you now need to start looking at them to say, okay, the only zones that I'm going to focus on are those that are going to be found within my discount if I'm looking for a buy. So if in my discount, I found a continuation zone and there is a continuation or a breaker happens to be within here, all right, or a mitigation happens to be within here, all right, you're going to just mark it, all right, so that everything above, you may completely ignore them. So that now reduces, because now you're trying to box your strike zone, exactly where you'll be looking for your areas of interest. You understand?
Yeah.
Yeah. So you may have 2 or 3 zones, because all these cannot happen in one area. Okay. It's not possible that you're going to have all these 5 happening in one area. No, it's not.
Okay.
So
Yeah.
yeah. So there'll be situations where you just find a continuation zone. Sometimes you find a breaker. Sometimes you find what, you know, the flip zones, and all of these terms are just one and the same, but what it all matters in the end is for you just to look at this range, what is happening within this range. All right, so your goal is just to look at what is going on within this range. All right, as price is pulling back. So as price is pulling back, your goal is just to look at what is going on in that range. And even as you have reduced your scope to this range, all right, you've reduced your scope to this range only. Okay, you don't have to, you know, concern yourself with what happened on the left. Then the next step to reduce even your scope is these 2 right here. So now these 2 now even reduces your scope to even maybe 1 or 2 zones, all right, which you're just going to focus on. That's all. Okay, meaning that the rest, even if they are there, you're not so much concerned about them because they are not within your strike zone. So you are boxing price, bringing it to an area where now you can say, this is where I'm going to strike from. Yeah. But these are just those, you know, things that are just in your mind. And once we start looking at the market structure, I mean, we start looking at how you can identify supply and demand, you realize that most of these things, I'm not going to even be marking them, but I'll be mentioning them, but I'm not going to mark them to say, oh, okay, right here, we need to mark this, otherwise we're going to paint the whole chart.
Yeah, this is what I'm doing right now. I'm having my zones all over the chart, and I don't know which one to trade.
Yeah, you see, you're going to paint your whole chart. You're going to paint it, and you'll be confused in that way.
Yeah,
right?
yeah, right.
Yeah. So That's right. So I'm still going to show you how you can just identify the most important thing. I used to also paint my chart. I would paint my chart with a lot of zones such that I wouldn't even know which zone I'm supposed to take. So I had so many zones to a point that I was afraid to take a trade because I didn't know whether that zone is going to hold or not.
Yes, exactly.
I don't need this anymore. All I need is, I just need this. I just need this. So I've simplified my trading to a point that, even if I'm just with a phone, my MT4 on the phone, I'm able to take a trade. Most of the trades that I take on a daily basis, I don't take them by analyzing the charts on TradingView. I just, wherever I am with my MT4, I know where price is going to react from, and I will just take the trades like that because of simplicity. Okay. So the last part that we're going to look at is what happens with unmitigated zones. So this point is going to help you so much. Market structure is more important than supply and demand and liquidity concepts. Okay, very important. Market structure is more important than supply and demand and liquidity concepts. Okay, so meaning that always follow what market structure tells you, then you start looking for your supply and demand and your liquidity concepts. And this is what it means. So we have a high, a higher low, then a higher high, then price reacts off of this, what we call maybe a mitigation or a break and retest. And then price pushes again to the upside, and then price comes and reacts off of a zone above. All right, then price pushes to the upside, then again price comes a little bit lower, then price pushes to the upside. So what we are having right here is, if we map our zones correctly, so we have a break of structure right here. Okay, break of structure. So I want to finish all the theory today, so that I think Thursday we can finish off with mapping of the zones. Okay, so don't have to go back to the theory. Okay, so we have the break of structure again today. I mean, not right there. Then we also have a break of structure. So structure, as we know it, is not perfect. So it is always imperfect. And we just have to accept it. All right, so we have all these zones. I mean, all these breaks of structure. Then the next thing that we need to look at is, once we have a confirmation of a trend, we need to look for proper zones. So let's say in this area right here, price never came back to our premium. So let's say we had, never came back to discount, to our discount zone. If we had two zones, let's say we even had a continuation right here, let's say none of these zones were mitigated, so we leave them. All right, or if you don't want, you don't have to draw them, you can just know that, okay, in this range we didn't mitigate, so that even as price is coming, you can still put your premium versus discount and look at that particular range to say, okay, in this range, price never mitigated any of our discounted zone, because the goal of this pullback was to come and mitigate either this one or this one. All right, but it failed to do that, and it mitigated what? Maybe it was a break and retest. This time around, retail guys, maximized on that move, and we were left out. Okay, because it happens. So
of course.
They maximized it, and we were left out, feeling with the feelings of rage and anger, and price just went like that. And then again, the next range, we look for opportunities, because our strategy tells us to say, hey, buy from the discount. So we are very faithful in following our strategy. So again, let's say we identified one zone and another zone, let's say two zones in this range, and again we can see price never came back to our discount. So again, there was the rage, because another guy, according to their strategy, they thought, okay, trend line guys, those that thought, okay, this is a nice trend line, you get it, they bought the market right there, and we were left out again. All right, different strategies, and they keep on maximizing the market. We don't have to change our strategy, keep on holding on, because even then that trend line at one point they also take a loss, and yeah, so it happens in the market. So the next time again we see a break of structure right here, and what happens, price then comes down, and this time around, let's say we took that nice buy and we're also happy. So, okay, this time around price came to our demand zone. This demand zone was mitigated. So we can see that down here, we've got a lot of unmitigated zones that price never came back for. So we've got a lot of unmitigated zones. We've got this one, we've got this one, and all of these zones that price never came back for. And then again, we take our discount and premium to, we put it right here, and we're expecting a buy this time around, because after all, we are loyal to our strategy and we don't want to break our rules. Okay, so we're expecting that price is going to come here, or price is going to mitigate this area right here. So these are the two zones that, let's say, we have identified in our discount. And now price begins to pull back. All right, so as price is pulling back, we can see we have a small reaction, fails, price comes here, gives us even a nice reaction. Then what happens? Price then breaks. So after price breaks, these zones are no longer valid for now, and we're not going to look at them anymore. Why? Because price has just broken a demand zone, which was once strong. Now we are unconfirmed bearish. So it is at this point where now we are open to both what? Buys and sells, right? Because we just had one high and one low, unconfirmed bearish, and we have these zones right here. Now, once one demand zone fails, the assumption is that the next demand is also going to be weak, all right? So here, this demand has done what? Has failed. So the assumption is that the next demand is not going to hold as well. So we are not going to start looking for long buys here, thinking that price will react, because what now many, and I've done it before, is we start looking to buying the market here. So we start targeting these areas now to say, oh, okay, we have this unmitigated zone, so price, orders are still here, price will still come back here, and we'll get this, the trade. And what the market is going to do, because at this point we are open to both buys and sells, so what we may expect to see right here is price may pull back, give us those buys and maybe hit this area, then continue going to the downside.
Yeah.
So what did we have? We only had a reaction on that area. So price just gave us a what? A reaction. You understand? Now, at this point, we have two lows and two highs. We are now in a what? In a confirmed trend. So we break another structure right here, and we are now confirmed bearish. So if now we are confirmed bearish, all these demand zones are just going to be used as what? As reaction. It depends with the time frame that you're using. Some reaction, if it's a higher time frame, like daily, the reaction may be quite big, which on the lower time frame could be a trend which you can capitalize on. If you're trading a lower time frame, let's say M15, M30, then these are just going to be reaction point to facilitate a pullback, to go and respect maybe the supply right here, and price may go. Sometimes these may even be smaller, reaction, and price will break them. Okay, why? Because price structure is more important than what? Than supply and demand. So all these odd demand zones that price never reached down to mitigate, once price gets there, they're just going to be used as areas of what? Interest for the facilitation of pullbacks in order for the market to continue downtrend. Okay, so that's how are supposed to follow the market. So our goal now is to look for selling opportunities to the downside. That's all. Okay, so, and this is where we may end our supply and demand theory lesson. The next lesson that we're going to look at will be more of the practical. It will be practical, not more of. We'll get this information and the charts and see how we can now use it, so that you see how you can identify those supply and demand, and see how you can just make it part of you.
Yeah, awesome.
Okay. Any questions, any contribution, any addition?
No, this was quite clear. Some parts I already knew, but you know, it is always about the whole picture and putting it all together, and yeah, making it really clear how we use it and how we utilize all this. And that was
Okay.
really great. Thank you a lot.
All right. I'm also pleased that it's making sense and you can resonate with it, and it's something that something that is so familiar to you. My goal, my desire is to see you become more profitable, like on a daily basis, you're banking on some huge serious profits. That's my
Yeah,
goal.
yeah. I think my first goal would be to be profitable at all, because currently, you know, there are several things that are obstacles for me in this. And one of my obstacles is, for example, is for sure the time, because I'm working full time and somehow I have to make the transition. And I think what helps me a lot is to be really sure about what I'm doing, because when I'm
Exactly.
really sure about what I'm doing, then I can also just trade at a small window of time that is available for me, and
Exactly.
I can do something useful there.
Exactly. Exactly.
Yeah,
And
yeah,
that window is going to be given to you, is going to be created. The most important thing is once you master the skill, the window is not going to be an issue for you, because like for me, the level where I've reached, I can even have a full-time job and yet be able to trade effectively, because now it has become like it's a second nature thing. It's a thing where I know where, because I've just been focusing on Nasdaq alone. So it's like I know where Nasdaq is coming from, where it is going, where it has reached, when to trade, when to stay out, and all those things. Okay,
yeah,
so
yeah,
sometimes I would even go for a full week, you know, just taking wins and wins and wins and wins to the point where I started doubting myself. It's, you know, you start doubting your results. It's, I think I'm just faking this. Is this real? But it's a point where it comes with mastery.
yeah,
All right?
yeah.
It comes with mastery. So
Exactly.
the
I
more,
mean, I think this is always when you really master something, then it becomes easier, and then it becomes unconscious knowledge that you can apply without even big thinking. And this
yeah,
is where we have to get to.
exactly. And you are going to get there. I know that you're going to get there.
That sounds so good. Yeah.
Yes, all right, sir. Have a blessed evening and good night. I'll see you on Thursday.
All right. See you on Thursday.
Okay, bye.
Have a good night. Bye bye.
Okay.